Right, hi guys, welcome to my live stream. My name is Zahir Anwari, co-founder of Sublime Trading. We specialize in helping CEOs and high salary earners get consistent returns in the stock market using a simple trend following strategy and in only 30 to 60 minutes a week. So before I go live, if you could just give me a little heads up in the chat box, let me know you can hear me, let me know you can see my screen okay. I am going to be doing a deep dive analysis into Tesla. We're going to be looking at the higher time frames, the monthly, the weekly, and the daily time frames. Excuse me, and get a real deep dive and sense of how the stock is performing and what the stock is doing right now, what it's done in the past, what the stock is doing right now, and potentially what we could see the stock do going forward. And based on that analysis, is Tesla a stock that you want in your portfolio? Now, we know Tesla gets a lot of headlines for whatever reasons, good reasons, bad reasons. You like Elon Musk, you don't like Elon Musk, the knock on effect to Twitter and everything that's surrounding that. So Tesla is a stock that gets a lot of coverage. Rightly or wrongly, it doesn't matter. It gets a lot of coverage. What we want to be able to do is stay impartial to all of that noise that we're bombarded with, and we really want to focus on the stock price, and make an objective decision based on the stock performance on whether it's the right stock to have in your portfolio or not. Okay, once we've looked at Tesla, we will then look at a few other stocks in the tech sector just to get a feel for what's happening in the tech sector. And then if you guys have any questions, we'll go through that as well. Okay, so let's dive into the analysis. This is my typical three-screen setup. I have the monthly in the top left, the weekly in the top right, and the daily chart across the bottom. As a trend follower, I'm looking for the big moves in the market. So for the big moves, I need the higher time frames. When you move down to the intraday time frames, 1 hour, 15 minute, 5 minute, that's really where you get caught up with a lot of noise and ultimately where there's no money to be made. You want to be focusing on the higher time frames where you do less work for more profit. There's an element of patience involved, and that's often where people struggle or let themselves down because, of course, we want money and you want money today, but that's not the way to invest. During low probability environments, you want to apply patience. During high probability environments, that's when you want to be taking positions. Okay, so I like to start with a monthly, then move across to the weekly, and then come down to the daily. So let's start with the monthly time frame on Tesla. Now, the thing about Tesla is that it's a very volatile stock. And you can see that based on the history. When it went IPO in 2010, it held pretty well in terms of an IPO. Normally, when a stock IPOs, it tends to tank. But this particular stock held very well, stayed in this sort of range up until 2013, and then it exploded, created this high in 2014. Not the smoothest of movements as well. You can see deep pullbacks. Then 2014 up until 2017, there was this sideways market. Then we had a burst out of that consolidation. But price didn't really go anywhere. It sort of swung back down into consolidation, remained within a sideways market up until 2019. That's December of 2019. And that's really when it started skyrocketing. And it went from roughly sort of $25 to the high of just short of $420. So, I mean, that's a huge climb. You're looking at a run of 1,375%. I mean, that's a massive run in terms of a stock. But again, if you look at the way it's performed, it had a move, pullback, another move, then it went through this sort of messy consolidation. Then we had this run up, and it was particularly October of 21, where it was quite an oversized candle. Then momentum continued, came to around that $400 mark, pierced above it, and since then it's been in this decline. And since that high point, the stock has declined by roughly 58 to 60%. So the question now is, based on where price is right now, is this a stock that you want to consider for the portfolio? Now, of course, it depends on your approach first and foremost. If you're a value investor, if you like to buy stocks that are cheap in price or that are weakening, and what you're hoping for is for the market to find some kind of support level and then start moving in your favor, then Tesla may be of interest because you like cheap stocks or stocks that are on the way down. But that opens up a whole can of worms and a whole load of problems. And we'll look at that in more detail in a second. But ultimately, what we can see right now is that this decline in price has taken price below this red line. So we've got the green line up here and the red line. The green line is the high of the previous calendar year. So this is the highest point of 2021. And this is the lowest point of 2021. If the market is trading above the highest point of last year, it's a bull market. If it's trading below the lowest point of last year, it's a bear market. And if price is trading inside these levels, then generally it's more of a sideways market or a market that's correcting. Tesla has been on this huge decline. And if we look at last month, November, it attempted it was trading below the lowest point of last year, closed above it. But if we look at December, the weakness of this month has taken price below the lowest point of last year. So this is where we're in very interesting territory because potentially we could see further weakness and price could move towards that $100 round number. To get a clearer picture, we of course need to bring in the weekly and the daily time frame. If we go down to the weekly time frame, now what's positive or what's a positive sign for the bulls or the buyers is that the market is now trading just above the 200 simple moving average, which is this black line. The 200 simple moving average is a proven level of support and resistance. Now, first and foremost, we can see that price has remained above the 200 moving average throughout this decline. If we go back to when it last broke above the 200 moving average, that was in October of 2019. And we can see since then that it has remained above the 200 moving average. In general, it's been using the 50 simple moving average as a support zone, but eventually broke through it in April of this year, came back to retest it as resistance, and we've had further weakness. And price is now at the 200 simple moving average. So what does this mean? What this means is that price is at that very last level of support that could potentially push price to the upside. So if you trade off the 200 simple moving averages, then this would be an area where you potentially may look to buy into this stock. And as a result of that, you're looking for the stock to move higher. If we come down to the daily time frame, now the daily time frame paints a very different picture. We can see that the daily time frame is actually below the 200 simple moving average. Hi, Trading View. Thank you for the coins. We can see that price is below the 200 simple moving average. It's below the 50 and it's below the 20 simple moving averages. So the orange is the 50 simple moving average. The blue line is the 20 simple moving average. And since this area here, which is September, we've seen weakness and how price has been using the 20 simple moving average as a level of resistance. So it's been pushing its way down. It's been working its way down. So what do we have looking across all three timeframes, looking objectively? So if we put opinions aside, if we put our feelings and our wants and our desire, maybe you like Tesla as a brand, maybe you don't like Elon Musk, maybe you do like Elon Musk. There's all of these sort of thoughts and ideas and opinions that can come into your analysis that can actually cloud your judgment. So what we want to do is we want to look at the charts and objectively make a decision based on what the stock performance itself is doing. So across the board, we have a mixture of bullish and bearish factors. And that for me is a reason enough to stand aside and not buy Tesla. First of all, as already mentioned, it's a very volatile stock. It doesn't have a very good history of performance in terms of a nice, neat history of performance. It moves, it consolidates, it can swing against you. It's a very volatile stock. And so that's what I mean. Yes, it's moved over 1,300% in that time. And if you're willing to sit through the swings for the profit that you can accumulate, fine, no problem. For me, as an investor, I like stocks that have a much smoother history of performance. It's not about being right; it's about making profit, and it's about making profit as seamlessly as possible. And Tesla doesn't always fit that profile. The monthly time frame, as already mentioned, is trading below the lowest point of last year. If it closes below that by the end of the year, we could see further weakness. On the weekly time frame, price is below the 50 simple moving average. It's above the 200 simple moving average. And my trend filter is red, which is telling me that there is a bearish trend in progress. However, the 200 simple moving average on the weekly could be the very last stranglehold, rather, for the bulls, where the buyers could come in and start pushing price up. And if we come down to the daily time frame, well, price is below all three moving averages, and we can see that the trend filter is displaying red and grey. So there's too much bearishness, not enough bullishness for me to consider Tesla as a potential for the portfolio, and not one that I would consider at all, as I've already mentioned, based on past performance. So that's my analysis, guys. If you like that analysis, if you agree with that analysis, it'd be great to hear your thoughts. Do reach out to me with any questions or comments that you have, and you can of course leave comments once the recording goes live, and I do pick up the comments and I do get back to people. So do leave your thoughts and let me know your feedback on this analysis and your own analysis and thoughts in general. So look, Tesla is obviously a tech stock. It's in the tech sector. Let's have a look at some of the other stocks in the tech sector to see how they have been performing and potentially what we could see going forward for tech stocks. Now, first stock we'll look at is Apple. Let's have a look at the history of Apple. Now, we know Apple has a massive climb, has had a massive climb, certainly since 2009 up until the highest point of 2022. You're looking at a run of roughly, let's have a look, over 8,000%. Massive, okay? It's been on a huge run. If you haven't been in Apple or you've missed out on Apple, that's like part and parcel of life as an investor. There's always another stock that you can look into. If you missed Apple, don't worry about it. There's always another Apple emerging. Remember, it's not about investing in the brand name. It's about investing in the stock and the performance of the stock. Now, let's have a closer look at Apple. For me personally, I don't think Apple has the cleanest history. It moves, deep pullback, move, deep pullback, move, deep pullback, move all the way to this high point, another deep pullback. Currently a little bit messy. If you compare it to Tesla, you know, this is certainly in terms of the decline of this year, Apple hasn't declined anywhere near as much as Tesla. So what we're looking for in Apple is for Apple to find some kind of base and start working its way up. Currently, it's stuck in this consolidation. So let's have a look at the weekly and the daily, see what kind of picture they give us. The weekly time frame, very clearly in a sideways market. It's below the 50 simple moving average. It's above the 200 simple moving average. But the market itself is clearly just going sideways. And you can tell that, first of all, by the fact that price is quite clearly going sideways. But also, our trend filter has periods of green, periods of grey, and periods of red. Kind of looks like the Italian flag. When this happens, it's confirming a sideways market. Of course, you don't need the trend filter. You can physically see it. If we just simply draw the high point of the consolidation and the low point of the consolidation, very clearly in a sideways market. So if price breaks below the low, it will move towards a 200 moving average. If it breaks that, it'll move towards a $100 round number and so on. If momentum kicks in and pushes price to the upside, if it breaks and closes above the high of January of this year, then we're likely to see strength. Up until that moment when there's either a breakout to the downside or the upside, it's a consolidating market and where I would not consider taking any positions. I don't trade sideways markets. There's no money in it. It's a range market, and it's how people get swung in and out of positions and ultimately don't make the kind of profit that they want. Looking at the daily time frame, if I just compress the daily time frame, you can see the size of the consolidation in more detail. Look how flat the moving averages are. Look at the 200 simple moving average. It's flat. When it's in trend, you want all the moving averages to be angling up. So you can see how the 200, the 50, and the 20, they're all aligned. What I mean by that, the 20 is above the 50, which is above the 200, all angling up. In a sideways market, you can see that the moving averages are just going sideways. It's confirming we're in a flat market. Currently, the market is below the 200 moving average on the daily time frame as well. So again, similar to Tesla, a mixture of bullish and bearish factors. So not a stock that you really want to be considering. Okay, Microsoft. Now, Microsoft is a stock that is regularly in my portfolio. And what I mean by that is if you look at the monthly time frame, guys, look at the history of performance on Microsoft. This is the kind of stock that you want in your portfolio. Look how smooth that history is. And there's a lot of stocks that move like this. Again, if you compare it to Apple, Apple's very, very jerky, swings regularly, deep pullbacks along the way. Again, if you look at Tesla, not the smoothest of charts. If you go back to Microsoft, a really nice, clean history of performance. And that's the kind of stocks that I like to look for. Currently in a decline, just like the rest of the tech sector. You can see that it found support at the lowest point of last year. It's now bounced. For now, I'll be standing aside. If the market creates some kind of base and it looks like it's pushing higher, I will consider an entry. For now, I'll be standing aside on this. If you look at the weekly, below the 50, above the 200 simple moving averages, I want to see the market move above the 50 simple moving average on the weekly if I'm to start considering buying into this. Remember, I want my trend filter to be green, and I want it to be green above the 50 simple moving average. If you have a look here, the trend filter turned green, but it was below the 50 simple moving average, held as resistance, and the market was forced down. That's not what I want. What I want is the trend filter to be green above the 50 simple moving average. And that's when I could potentially start looking to buy into this. And again, if you look at the daily time frame, price is below the 200 moving average. Lots of red, lots of green, lots of gray, just a sideways market for now. Yes, it's also in a decline, but we are starting to see momentum to the upside. So if it works its way above the 200 moving average on the daily, then again, that's an early sign of bullish momentum. But for now, Microsoft is not a stock that I would consider for the portfolio until it sets up correctly. Okay, another stock is Nvidia, of course, a massive tech stock. Now, Nvidia has performed very, very well for me in the past. So I'll show you where I traded Nvidia in the past. First of all, Nvidia was in this long-term consolidation. Then it was in May 2016 when it first broke above the highest point, which was of 2007. And that's when it moved from roughly $10 to around $73. That was the first trend that I caught in Nvidia. I took my profit during that correction, stood aside, and then it was in May of 2020 when the market broke out again, and when we took another position, and you can see that from that point it went on the next leg from around $80 to the high of $350 roughly. And since that high point, of course, the market has been in decline, quite a significant decline. But again, guys, look at where it came to, the lowest point of last year, and it's now bounced. So the question is, are we going to see momentum to the upside, or is this a pullback before weakness, or will price remain at these low prices in some kind of sideways market? That remains to be seen. On the weekly time frame, price is still below the 5200 moving average. It's above the 200 moving average. If momentum takes price to the upside and the trend filter turns green, we could see further strength. And also on the daily time frame, we can see that price is now just below the 200 simple moving average. So it's at a very interesting position, because if the market, if the bears come in, they could force price back down toward that $100 round number. Or if this bullish momentum continues, breaks and closes above the 200 moving average, we could see further strength to the upside. We have no idea at this point. This is generally where the tech sector is. It's kind of in this no man's land where there's a mixture of bullish, bearish factors. It's underperforming against the indices. It's not really a sector that you want to be in. And this is really part and parcel of good investing. Good investing is really about identifying the strongest sectors in any period of trend, and then narrowing down to the strongest stocks in the strongest sectors. That's how you make consistent profit. Now, there's an art to that, because you need scanners, you need tools, and you need an analysis process that finds the best stocks. But it's all very, very simple to learn. You do need a bit of capital, of course, to subscribe to good scanners. A TradingView has a scanner which you could start with. But I have played around with the TradingView scanners, and there are certain limitations to it. With TradingView, it's really about the charting. If you want good scanners, you will need to look away from TradingView and look at some of the other professional scanners out there. Over time, we know that TradingView do a lot of improvements and are always updating their platform. Maybe the scanner will get better in time, but for now, there are certain limitations to the TradingView scanner. But once you've understood how to scan, so how to scan across sectors, and then how to scan for the strongest stocks in the strongest sectors, you won't get caught up and bogged down in brand names that just don't mean anything. Tesla, okay, great. It's a giant of a company. It's a solid brand name. You may love it, you may hate it. It doesn't matter. The point is, the stock right now is not a stock that you want to be in. Neither is Apple, neither is Microsoft, neither is Nvidia. Not now. That could change in the future, but right now, these aren't stocks that you want to be in. Let's have a look at one last stock, PayPal. It's a tech stock. I mean, I've analyzed PayPal to death, pretty much all of this year. If you follow me on a regular basis, not just here on TradingView, but LinkedIn and all the other platforms I talk about. And I'm like, I've said this is a terrible, terrible stock to want anywhere near your portfolio. What tends to happen is that when you go down the Warren Buffett approach, the undervalued approach, where you're looking for stocks that are dropping in price and you want that to skyrocket in your favor, what can happen is that you end up in the scenario of catching a falling knife. You will have heard that expression. And what that means is that, let's say PayPal, when it dropped to $260, and the idea is you buy in at $260 because you think it's undervalued and you expect it to skyrocket in your favor. It continues dropping to $240. At this point here, it's now an emotional journey. You think, okay, what do I do? Should I buy more? Should I just hold? You start stressing about it. You think, right, if I get to break even, I'll just cancel, I'll just cut out and get my money back. You start getting on this emotional roller coaster of a journey. And then it goes from $240 to $220, $220 to $200. And if you haven't got risk management in play, if you haven't got an exit management in play, you then end up in this scenario where you have a stock that has just tanked, and you now have to see it do a hell of a lot of work for you to get back to break even, which is all the way up here. So let's say initially you bought in at $260, the stock now is at $80 or less than $80. So you've got to wait for the stock to go all the way back up to $260 just to break even. And when is it going to do that? It could stay at these low prices for months, maybe years, before it even starts going up to those levels. And you may have experienced this already. You may be experiencing this right now, where you have a stock you bought in because it was dropping in price, hoping that it would reverse, and instead that stock just keeps on going against you. It's a classic mistake, and why you don't want to be buying undervalued stocks. Stocks that are dropping in price are very likely to continue dropping, or at least stay at very low prices for a long period of time before it starts returning a profit or even getting back to break even. It's a very, very, very inefficient approach. Now, Warren Buffett can get away with it. He's got very deep pockets and he can hold positions in negative for long periods of time. But even when you're trading with 6 figures or 7 figures, it's not an approach that you want. It's not efficient. This is why trend following is so much more powerful than undervalue investing, because trend following, what you do, as I've already mentioned, is you wait for the market to dictate a direction. Now, I've talked about the S&P 500 in previous videos. Once the S&P 500 confirms a direction, bullish or bearish, you then go to your scanners, you scan across sectors, and then you look for the strongest stocks in the strongest sectors in a bull market, and you look for the weakest stocks in the weakest sectors in a bear market. Ultimately, you're going in the direction of the market, and that's how you then consistently make profits. So typically, I would hold positions for 12 to 24 months, take my profit when the sectors start drying up, and then go back to my scanning process, find which sectors the money has moved into, find the strongest stocks in those sectors, and repeat again and again and again. And if you do this consistently, year in, year out, over 5, 10, 15, 20 years, you will see far greater returns than having an undervalued investor approach. So going back to PayPal, you can see it's a perfect example to catch a falling knife. All of these people who've been buying into PayPal while it's been going down, these guys will be struggling because they're holding a stock now that it just only seems to be wanting to go further to the downside. If you look at the weekly, below the 200 moving average, below the 50 simple moving average, we can see that it's stuck in a sideways market down here around the $80 mark. And on the daily time frame, prices below the 200 moving average, and clearly just stuck in a sideways market. If it breaks above the 200 moving average, there's still no guarantee that it's going to start shooting to the upside. It could break above the 200 moving average and just remain in a sideways market for a lengthy period of time before it starts moving to the upside. And again, remember, guys, PayPal is still a giant of a company. There's no disputing the numbers. If you look into PayPal, it's still a giant of a company, but the stock doesn't reflect the company financials. This is why looking at the charts and following the charts will put you in far better stead than looking at the fundamentals and trying to figure out where there's value or where there isn't value and all of that kind of stuff. Look at the chart performance. It's just far simpler. Okay, so that's the tech sector. In general, there aren't really any good stocks that are in the tech sector that you want in your portfolio. But let's have a look at a whole different stock altogether, healthcare. So going back to what I was saying, which is as an investor, you want to scan across the stock market You then want to scan the strongest stocks in the strongest sectors. Right now, healthcare is performing much better than tech sector. The tech sector had its time post corona up until the start of this year. The tech sector was booming. That is where you want it to be. Since the start of this year, the tech sector has tanked. So which sector is performing? Healthcare has been performing. ABC is a stock. First of all, we can see it has a very good history of performance, particularly from 2008 up until 2015, a 7-year performance, really nice clean trend. It's then gone through a lengthy area of consolidation. So from that high point, 2015, up until the breakout of December of last year, this is when we took a position. We're holding our positions, and we can see that it's starting to move to the upside. Had to apply a little bit of patience, but that's okay because this year has been a year of correction. So stocks, even if they have been trending, haven't moved very, very quickly. Sometimes you've just got to let the market unfold and take its time. And that's what's happening here with with ABC, which is in healthcare. But you can see that it's moved quite nicely to the upside. What we're looking for is further momentum towards that $200 round number and beyond. If you go to the weekly, we can see that price above the 200, the 50 simple moving averages, the trend filter is green, and also on the daily time frame, price above all 3 moving averages. The trend filter is grey. There was a bit of a gap down. Would that be for earnings? I'm not 100% sure. I'd have to look. Sometimes when you see gaps like this, it could be because of earnings, and that can happen. It's not a gap to be overly concerned about. It's now at the 20 simple moving average. This could find support, and the gap gets filled, and we could see momentum back to the upside. But if you look at how stocks move when they're trending, there are pullbacks and corrections in the trend. So this is all this is for now. And the next stock, the final stock we will look at, is a stock again that I've repeatedly talked about. That is McKesson Corporation. I mean, look at this. This again, this is in healthcare, and if you look at its performance, its history of performance, got a really nice history of performance. It went through a lengthy period of consolidation, which is great. I love stocks that have consolidated because they act as a base for the next leg. You know the expression, the longer the consolidation, the bigger the breakout. This is an example. This was a lengthy consolidation from 2015 to the breakout in December of last year. This is when we took a position. And since we've taken our position, at the highest point, it had trended 65%. It's currently around 53%. That's okay. It's in a bit of a pullback. That's fine. We're looking for the market to find support and a continuation to the upside. If you go to the weekly time frame, if I just open that up, we can see that price above the 200 moving average. Nice clean trend in play. And on the daily time frame, price above the 200 moving average, but just in a bit of a sideways market at the moment. That's okay. It happens. Also, remember, guys, we're now coming into December. Yes, we could expect the Santa Claus rally. That can happen. But then again, it may not happen. And if the Santa Claus rally doesn't happen, then generally what happens is that market sort of stays sideways before momentum starts kicking in at the start of next year. So for now, we are still long on this. We've been holding positions. We've got multiple positions in play, and we'll continue holding onto this stock until the market breaks out and then continues to the upside. Okay, so that is my live stream for today, guys. For now, just in summary, not really interested in the tech sector. Standing aside from that, we are looking at healthcare. Lots of good stocks in the healthcare sector that are setting up and breaking out. Financials, another sector to keep an eye out on. Energy, another sector. So, don't get caught up in brand names. Don't get caught up in opinions. Don't allow ego to take over and cloud your decision. Stay objective, which is what good investors do. Focus on the charts and let the charts guide your decisions. Okay, I can't see any questions coming through. I'm just going to say thank you to TradingView again for the coins. Still getting familiar with what these coins mean, but I think it's a good thing. And I'll have a look into how we collect these coins and potentially how we could spend these coins. I don't know if these coins allow us, if we're allowed to spend them on the platform in some way, but appreciate the coins. All right. there aren't any other questions coming through, so I'm going to end the live stream here, and I will be back with another live stream this week, particularly if we see anything interesting happening on the S&P 500. All right, guys, have a lovely rest of the day, and I'll see you very, very soon. Take care. Bye.